$312,000. That's the number. Write it down if you need to, because by the end of this video, you're going to understand exactly how that number was built. One lie, one forged signature, one market downturn at a time. $312,000 stolen over 14 years by a man who spent 3 decades telling me I was a disappointment of the family. My father is a certified public accountant. He has a framed photo in his office of himself shaking hands with the mayor of Dayton, Ohio. He coaches Little League. He gives a toast at every wedding. Everyone in our town called him Gordon, like he's their favorite uncle. And for 30 years, he called me a failure to my face at Thanksgiving in front of my own daughter, while he was quietly bleeding my inheritance dry to pay for a second life I didn't know existed. I'm going to tell you how I found out. I'm going to tell you how I built the case, bite by bite, bank statement by bank statement, without him ever suspecting a thing. And I'm going to tell you what happened on a stage in front of 800 people with a TEDx banner behind me and my father sitting in the third row expecting to watch his disappointing daughter fail one more time. He thought he got away with it. He was wrong. Before we get into how this happened, I want you to sit with the shape of it for a second, because I think it's what makes this story different from a lot of the ones we usually cover here. This isn't a con artist who slid into someone's DMs promising crypto returns. This isn't a stranger who called pretending to be from the IRS. This is a man who filed my taxes, who walked me down the aisle, who sat in the front pew at my grandmother's funeral and cried real tears, while, according to records I would later hold in my own hands, he had already begun moving her money out from under the people she left it to. If you've ever had a gut feeling about a family member's finances that you've talked yourself out of because they're your parents, because they'd never, because surely you're misreading it, I promise you, by the end of this video, you're going to feel a lot more confident about trusting that instinct. Welcome back. If you're new here, this channel is where we tell the stories that never make the evening news, the quiet financial crimes that happen inside families, inside trust funds, inside we're just helping you manage your money, conversations that turn into decades of theft. Today's story is about greed. It's about betrayal wearing a nice cardigan and a CPA license. And most of all, it's about getting every single dollar back, with interest, in front of an audience that would make sure he could never do it to anyone else again. If you believe people like this deserve to be exposed, not just quietly settled with, not just written off as family stuff, hit subscribe right now, because we do one of these every single week. And this community exists because people like you refuse to look away. Let's get into it. My name is Rachel Bennett. I grew up in Kettering, a suburb just outside Dayton, Ohio, in a split-level house with a flagpole in the front yard and a father who measured love in report cards and trophies. My dad, Gordon Bennett, built his accounting practice from a single rented office above a dry cleaner into Bennett and Associates, a firm that by the time I was in high school handled the books for half the small businesses on our side of the county. He was, by every outward measure, a pillar. Rotary Club, church treasurer, the guy people called when the IRS sent them a scary letter. At home, he ran the family like a ledger. Every choice got weighed in terms of return on investment. My older brother, Kyle, played football, got a business degree, and eventually opened a car dealership with money my father called a loan, though I would later learn the word loan in my father's vocabulary meant something very different from what the rest of us understood it to mean. Kyle was, in my father's words, a doer. Kyle understood money. Kyle understood how the world actually worked. I understood people. I wanted to be a social worker. Later, I became a nonprofit program director and eventually a public speaker and consultant, helping community organizations build financial literacy programs for low-income families, teaching the exact skills my father claimed I didn't have. But growing up, that path had a name in my house, and the name was disappointment. I remember being 14 years old, bringing home a report card with 3 A's and a B+ in geometry, and my father looking at it across the dinner table and saying, "Kyle got a B+, and I understood it. What's your excuse?" I remember being 22, telling him I'd taken a job at a domestic violence shelter instead of applying to law school like he wanted, and him setting down his fork and saying, "You're going to spend your whole life being poor and thinking it's noble." I remember my wedding, when he stood up to give a toast and in front of 140 guests joked that he'd finally found someone willing to take the disappointment off his hands. Everyone laughed. I laughed too, because that's what you do. You learn to laugh at your own erasure, so nobody has to watch you flinch. Here's the part of the story you need to understand, because it's the foundation everything else is built on. My grandmother, my father's mother, Eleanor Bennett, was a school teacher who married well and invested wisely. When she passed away in 2003, she left behind an estate worth just over $1 million, split into what her will called the Eleanor Bennett Educational and Opportunity Trust. Kyle and I were named as equal beneficiaries, roughly $340,000 each, structured as a discretionary trust meant to fund education, first homes, and life-launching opportunities, to be distributed at the trustee's discretion until each grandchild turned 45, at which point whatever remained would be paid out in full. And the trustee, the person legally responsible for managing that money, investing it prudently and acting solely in our best interest, was my father. At the time, this seemed not just reasonable, but obviously right. He was a CPA. He managed trust accounts professionally for half the town. Who better to steward his own mother's estate than a man who did this for a living? The attorney who drew up the will didn't blink. Neither did I. I was 26 years old, newly married, working at a shelter making $31,000 a year, and the idea that my father, the man who'd built an entire career around ethics, compliance, and fiduciary responsibility, would touch a cent of that money for anything other than my benefit, never once crossed my mind. That trust of mine is the crime scene of this entire story. Everything that happens from here happened inside an account I was legally entitled to see, managed by a man who made absolutely sure, for 14 years, that I never really looked. Here's a piece of financial terminology worth understanding, because it matters for everything that comes later. A discretionary trust gives the trustee wide latitude over when and how much to distribute, which is normal and common. What is not normal is when the trustee is also the sole account signatory, the person who prepares the annual accountings, and the person who chooses, every single year, not to send those accountings to the beneficiary unless asked. My father never hid the trust's existence from me. That would have been too obvious, too risky. Instead, he did something much smarter. He made himself the only source of information about it. Every year or two, at a holiday dinner or a phone call, he'd mention it casually. "The trust's doing fine, don't worry about it. Market's been rough, but we're staying the course. I moved some of it into something more conservative after '08. You don't need to worry about the details." I didn't ask for statements. Why would I? He was my father. He was a professional. And every time the subject came up, he'd frame any interest I showed as a kind of insult. "What, you don't trust me now?" Which, when you've spent your whole childhood being told you don't understand money, is an incredibly effective way to make sure you never ask twice. That's the red flag I want you to sit with for a second. Because I promise you, if you're watching this, you've either lived some version of it or you know someone who has. The most dangerous financial predators in our lives are rarely strangers. They're the ones who've spent years training us to believe we're not qualified to check their work. The earliest fraudulent withdrawal I would eventually trace back to 2009, 6 years after my grandmother's death, in the exact months following the 2008 financial crisis. My father told Kyle and me at Christmas that year that the trust had taken a hit like everybody's portfolio, and that he'd shifted the remaining funds into safer, more liquid instruments to protect what was left. It was a believable story. Everyone's 401k had cratered that year. Nobody questioned it. What actually happened, according to records I would not see for another 13 years, is that in March of 2009, my father opened a new entity called Whitfield Capital Advisory LLC, Whitfield being my grandmother's maiden name, a detail I now understand was chosen deliberately so that any stray mention of Whitfield in a financial document would look like it belonged to the estate, and began transferring funds from the trust's brokerage account into that LLC's operating account in increments small enough to avoid triggering any bank's automated fraud review. $12,000 here, $18,000 there, always under the $20,000 threshold that most compliance software flags for manual review. Over the following 14 years, those transfers would happen more than 60 times. To understand how this fraud survived undetected for 14 years, you have to understand how thoroughly my father had built himself into the fabric of trust in our town. Kettering isn't a big place. Everyone who mattered to my father's business knew him from somewhere else, too. The church finance committee, the Little League board, the Rotary Club he'd belonged to since before I was born. When you are the guy who balances the books for the church, coaches the team the mayor's kid plays on, and gets a plaque every few years for outstanding community service, you accumulate something that functions almost like a credit score for trustworthiness. Except, unlike an actual credit score, nobody ever audits it. That reputation did real work for him. It's the reason my grandmother named him trustee without a second thought, despite the will's original intent that the money stay professionally custodied. It's the reason none of his accounting clients ever asked to see a peer review of his firm's compliance practices. It's the reason that when I finally did start asking questions, his default response, mild disbelief that I would question him at all, landed as credible to everyone around us, including, for a while, me. A con man who looks like a con man is easy to stop. A con man who coaches your kid's baseball team and cries at his own mother's funeral is a much harder problem, and I think that's worth sitting with, because most of the financial predators people write to me about aren't wearing a trench coat and sunglasses. They're wearing a Rotary Club pin. I want to spend one more minute here, because if you grew up in a house like mine, I think you already know why this matters to the rest of the story. My father didn't call me a disappointment in one dramatic blow-up. It was a drip, drip, drip spread across 3 decades, delivered so casually that for most of my life, I didn't even register it as cruelty. I registered it as feedback, constructive even. A father trying to motivate his underachieving daughter. There was the summer I was 16 and got a scholarship to a state journalism camp, and he told me, "That's nice, but it's not going to pay any bills." There was the year I turned down a marketing job with better pay to take the shelter position, and he said at a family barbecue in front of my aunts and uncle, "She likes being broke. I think it makes her feel important." There was my 30th birthday when he raised a glass and said, only half joking, "To Rachel, proof that not every investment pays off." Every one of those comments on its own is the kind of thing you can brush off. Families say cutting things sometimes, but strung together across 30 years, they built something specific and durable in me, a deep, reflexive belief that I was bad with money, bad with practical decisions, and lucky that anyone in my family put up with me. That belief is exactly what made me the perfect mark. A confident, financially literate person questions a vague trust statement. A person who has spent 30 years being told she doesn't understand money defers. I've talked to a forensic psychologist since all of this happened, in the process of trying to understand my own family, and she used a phrase that stuck with me: reputational laundering. My father didn't just launder money through Whitfield Capital Advisory, he laundered his own credibility through me, using my manufactured incompetence as cover for his actual theft. Every time I hesitated to ask a hard question, it wasn't because I lacked the ability. It was because he'd spent 3 decades building the exact psychological conditions that would make sure I never asked. I promised you at the top of this video that some of this would feel familiar. So before we move into how everything unraveled, I want to lay out plainly the specific red flags that were present in my life for years before I ever acted on them, because I hear from viewers constantly that this is the part of these stories that actually changes how they manage their own finances. The first flag was a trustee who was also the sole source of information about the accounts. In a healthy fiduciary relationship, a beneficiary can request statements at any time from the custodian directly without going through the trustee as a gatekeeper. I never once in 14 years contacted a custodian directly. I only ever received what my father chose to hand me. The second flag was the use of vague, emotionally loaded language. Instead of specific numbers, the market's been rough. It's complicated. You don't need to worry about the details. Legitimate financial professionals, in my experience working alongside plenty of them through my nonprofit, love specifics. They want to show you the number, the percentage, the fund name, because specificity is how trust is actually built. Vagueness, dressed up as protection, is far more often a way of making sure you never have enough information to ask a follow-up question. The third flag was punishing curiosity. Every single time I showed even mild interest in the trust's performance, I was met with some version of, "Don't you trust me?" which reframes a completely reasonable request as a moral failing on my part. That's a tactic, not a personality quirk, and it is depressingly common in financial abuse cases involving family members, specifically because it weaponizes love and loyalty against the very instinct that would have protected me. The fourth flag, and the one I think is easiest to miss from the inside, was the existence of a shell entity with a name deliberately chosen to blend into the family. If you are ever the beneficiary of a trust, an estate, or a joint account, and you learn that money has moved into any entity you don't personally control or recognize, regardless of how official or familiar the name sounds, that is worth investigating immediately, not eventually. There's one more piece of Act 1 worth including, because it's the first time, in hindsight, that the numbers should have raised a flag and didn't. When I got married at 28, my father offered to pay for half the wedding, a generous public gesture that he made sure everyone at the rehearsal dinner heard about. What I didn't know at the time, and wouldn't discover until Dave and I went through the records years later, is that the $11,000 he contributed to my wedding was pulled directly from my own trust account and then presented to me and to the entire extended family as a gift from him personally. It is a strange, specific kind of theft to steal someone's own money and then receive credit, applause even, for generosity. But that was the pattern. Every distribution that technically should have gone to me on paper, with my knowledge, was instead reframed as evidence of his benevolence. I spent years being grateful to a man for giving me pieces of what was already mine. That's Act 1. That's the world I grew up in, and that's the moment the theft began, quietly, legally camouflaged, using a name that was supposed to protect it from ever being questioned. In the next act, I'll show you exactly how I found out and just how far my father was willing to go to keep me from ever finding the smoking gun. Fast forward to October of 2022. I was 39 years old, mother of 2, running my own consulting business, Benig Bright Futures, a financial literacy nonprofit I'd built from nothing over 8 years, teaching budgeting, credit repair, and home ownership readiness to families in under-resourced parts of Dayton. It's worth pausing on the irony here, because it will matter later. I had spent nearly a decade of my professional life teaching other people how to read a bank statement, how to spot predatory lending, how to protect their money from people who wanted to take it. I had built my entire career around financial literacy, and I still had no idea my own trust fund was being drained by the man who raised me. That October, my husband and I decided to refinance our mortgage. Our loan officer asked for documentation of any additional assets, including trusts, to strengthen our application. I called my father to ask him to send over the most recent trust statement, a completely routine, unremarkable request. He hesitated, just for a second, just long enough that, looking back, I should have heard it. Then he said, "I'll have my office pull it together. It might take a few days. The custodian's been slow lately." 3 weeks passed. I called twice more. Each time a new excuse. The custodian changed systems, the statement got mailed to the wrong address, he was swamped with tax season prep even though it was October. Finally, in early November, an envelope arrived. Inside was a single-page account summary from a brokerage I didn't recognize, showing a current balance of $28,412. $28,000, not $340,000, $28,000. I remember sitting at my kitchen table with that piece of paper, reading the number over and over, genuinely believing I was misunderstanding something. I called him immediately. He answered on the fourth ring, and when I read him the balance, there was a pause, and then he said, calm as anything, "Yeah, the market's been brutal, and you had some distributions along the way you probably forgot about. College, the wedding, the down payment on your first house." That last part was true, technically. The trust had paid for about $11,000 of documented, agreed-upon expenses over the years, things I remembered and had signed for. But $11,000 in legitimate distributions does not explain $300,000 in missing principal, even accounting for a bad market. I did the math in my head, badly, sitting at that table, and I knew, with the kind of certainty that makes your hands go cold, that the numbers he was giving me could not possibly be true. I asked him to send the full transaction history, not just a summary. Another 3 weeks of silence. When it finally came, it was 5 pages, heavily formatted, showing a series of investment losses in something called Meridian Growth Partners, a fund I had never heard of that, as it turned out, did not appear in any SEC filing, FINRA broker check, or state registration database. I know that because it was the first thing I checked at 11 o'clock at night, sitting on my bathroom floor so I wouldn't wake my husband. Meridian Growth Partners did not exist as a registered investment vehicle anywhere in the United States. That's when the floor of my entire childhood started to tilt. Before I tell you about confronting him, I want to be precise about what this actually cost me, because $312,000 is an abstraction until you sit with what it means in practice. Financially, it meant I had spent 14 years making decisions about a mortgage, about how aggressively to save for my kids' college funds, about whether I could afford to take a lower paying but more meaningful job, believing I had a financial safety net that in reality had been reduced to a fraction of its actual value. I had turned down a corporate consulting position in 2019 with a 40% pay increase, in parts because I told myself the trust gave me room to prioritize mission-driven work over money. I made that decision with numbers that were, unbeknownst to me, fiction. Emotionally, it meant relitigating my entire childhood in real time. Every memory of being called irresponsible, every joke at my expense about not understanding money had to be re-examined against the backdrop of a man who was, during those exact same years, siphoning 6 figures out of an account he controlled. The dissonance of that, being shamed for financial incompetence by the person actively committing financial crimes against you, is a specific, disorienting kind of injury that doesn't show up on any bank statement. Relationally, it meant I couldn't unknow what I knew, even in the months before I had proof. Holidays became performances. I sat across from my father at Easter dinner, 4 months after finding that manila envelope, watching him carve a ham, making small talk about my kids' school schedules, while a photograph of a wire authorization form sat in a folder on my laptop at home. I want to be honest that I'm not entirely sure how I got through that dinner. I think, if I'm being truthful, some part of me was still hoping I was wrong. I called a family meeting, just my father, my mother, and me, at their kitchen table, the same table where I'd been told for 30 years that I didn't understand money. I laid out what I found. I asked him, calmly, to explain Meridian Growth Partners. He didn't yell. That's important because it wasn't what I expected. He got very quiet, very controlled, and told me that I was twisting numbers I didn't understand, that trust accounting was complicated, that I was always looking for a reason to see the worst in him, and this is the line I will never forget. You want to accuse your own father of stealing from you after everything I've done for this family? My mother, who I don't believe knew anything at that point and who I want to be clear was never part of this, started crying and asked me to please not tear the family apart over a misunderstanding. I left that house with nothing resolved and a feeling in my chest I can only describe as the exact opposite of relief. Something had cracked open, and I understood, the way you understand a diagnosis before the doctor says the word out loud, that this was not a misunderstanding. This was a man who had spent 30 years calling me the family disappointment while doing something far worse than anything he'd ever accused me of. Over the following 2 weeks, I did what anyone with a research background does when they don't trust an answer. I started pulling every document I legally accessed. Ohio, like most states, gives a trust beneficiary the right to request a full accounting from the trustee, a legal document listing every transaction, every distribution, every investment, going back to the trust's inception. I sent my father a formal written request by certified mail, invoking that right by statute. He didn't respond within the 30-day window Ohio law allows. When I followed up, his attorney, not his personal attorney, but Bennett and Associates Corporate Counsel, sent a 2-paragraph letter stating that voluminous historical records would take time to compile and that my request was unnecessarily adversarial given ongoing family dynamics. That letter is what convinced me I needed a lawyer of my own. Not because I was certain, yet, that a crime had been committed, but because an innocent trustee with nothing to hide does not stall a legally mandated accounting for 2 months and then send a lawyer's letter accusing his own daughter of being adversarial for asking to see her own money. I want to tell you about one document because it's the moment this stopped being a suspicion and became a case. While waiting on the formal accounting, I remembered that my grandmother's original trust paperwork, along with old family financial documents, had been stored in filing boxes in my parents' basement, boxes I'd helped my mother sort through the previous spring during a spring cleaning project back before any of this started. I asked my mother if I could come by and go through them again, telling her only that I needed to find my grandmother's original will for legal reasons. She said yes. In the third box, behind a folder of old tax returns, I found a manila envelope labeled in my father's handwriting, WCA, MISC. Inside were 7 brokerage statements from an account I'd never seen before in the name of Whitfield Capital Advisory, LLC, the same Whitfield as my grandmother's maiden name. The statements showed regular incoming wire transfers, always between $11,000 and $19,000, going back years, and the account routing number on those statements matched, almost digit for digit, the custodian information listed on the very first trust statement my father had ever shown me, back in 2009. I sat on the floor of my parents' basement, surrounded by boxes of my grandmother's handwriting, and I photographed every page of those 7 statements with my phone before putting the envelope back exactly where I found it. That was the smoking gun. Not proof of the full amount, not yet, but proof that a shell entity existed, that it was receiving regular transfers matching the exact pattern of trust losses my father had been explaining away for over a decade, and that it bore my grandmother's name specifically so that no one would ever think to question it. I now had a name, Whitfield Capital Advisory, LLC, and a name in Ohio is a public record waiting to be pulled. I want to pause here and tell you what I didn't do, because I think it matters for anyone watching this who suspects something similar is happening in their own family. I did not confront him again. I did not tell my mother what I'd found. I did not post anything online, and I did not tell my brother. Every instinct in me wanted to march back into that kitchen and put the statements on the table and demand an explanation. But I had spent enough years working with families who'd been financially exploited to know one hard truth. The moment you show your hand to someone who controls the paper trail, that paper trail starts disappearing. Instead, I photographed everything I could find without disturbing it, put the envelope back exactly where I'd found it, in the exact folder in the exact box, and drove home in complete silence. My husband met me at the door and asked how it went, and I remember standing in our front hallway, still holding my car keys, saying, "I think my dad has been stealing from me since I was 26. Saying it out loud for the first time to someone who wasn't going to defend him was its own kind of turning point. He didn't tell me I was overreacting. He didn't tell me to give my father the benefit of the doubt. He just said, "Okay, what do we do first?" Once I had that first piece of documentary proof, something strange happened to my memory. Conversations I had filed away for years under "that's just dad" started rearranging themselves into a pattern. I remembered a Thanksgiving in 2014 when he'd mentioned, almost in passing, that he was putting some money into a new venture, nothing you'd need to worry about. I remembered him buying a boat in 2016 that he told everyone he'd financed through a good year at the firm. I remembered a 2-week trip to Florida in 2018 that he described as a conference, and how at the time I hadn't thought twice about it because why would I question where my own father went on vacation? I started keeping a private notebook, not evidence, just memory, dated as best I could reconstruct it, cross-referencing every vague financial comment he'd made over the years against what I now knew about Whitfield Capital Advisory's formation date. Almost every single one lined up, once I looked at it honestly, with a period when the LLC's bank records, which I didn't have yet but would soon, showed a spike in outgoing transfers. I want to lay out in one place the specific mechanics my father used to keep this hidden for 14 years, because I think understanding the method is almost as important as understanding the crime itself. These are patterns, not one-off tricks, and they show up in fraud cases far beyond mine. He structured transfers below reporting thresholds, keeping each one under $20,000 so that no single transaction would trigger a bank's automated large transaction review, spreading the theft across 61 separate withdrawals instead of a handful of large, conspicuous ones. He used a shell entity with a name, Whitfield Capital Advisory, deliberately chosen to sound like it belonged to the estate itself, so that if I ever glimpsed a statement or a bank name, it would read as consistent with my grandmother's affairs rather than as something foreign and alarming. He moved custody of the account away from a regulated independent trust company within a year of gaining control, eliminating the one layer of independence. Professional oversight that might have flagged irregular activity on its own. He controlled the flow of information entirely, ensuring I only ever received documents he had personally prepared, rather than anything coming directly from a custodian. And he relied, consistently and effectively, on emotional leverage, my role as the disappointment, to make sure that even when I did feel a flicker of doubt, I doubted myself before I ever doubted him. None of those mechanisms are exotic. They don't require sophisticated technology or criminal expertise. They require patience, a plausible cover story, and a victim who has been carefully trained not to ask questions, which is, I think, the most important thing I want you to take from this section. The theft itself was almost boringly simple. It was a psychological groundwork laid over 3 decades that made it possible. Before I said another word to anyone in my family, I spent close to 3 weeks doing what I now think of as due diligence on my own life. I checked the FINRA broker check database and confirmed my father held no registered investment advisor license, meaning that whatever he was doing with trust funds, he was not doing it as a licensed financial professional, only as a fiduciary trustee, which carries its own separate and, in some ways, even stricter legal obligations. I checked the Ohio Secretary of State's business filings again, more carefully this time, and found that Whitfield Capital Advisory LLC's articles of organization listed a professional services purpose so vague it could have meant almost anything. A common tactic, I would later learn from Dave, for entities designed to obscure rather than declare their actual function. I also, quietly, reached out to my grandmother's original estate attorney, who had retired but still had a small office in Kettering. I told her only that I had some questions about the trust's original structure. She remembered my grandmother well, sharp as anything. She read every page before she signed it, and confirmed something I hadn't known. My grandmother's original intent, stated explicitly in her instructions to the attorney, had been for the trust to be professionally custodied at a regulated trust company for its entire term, specifically so that nobody in the family would ever have unsupervised control of it. My father, as trustee, had the discretion to change custodians, a power the will did technically grant him, but the fact that he'd exercised that discretion just 1 year after gaining access, moving the accounts away from professional oversight and toward a structure only he controlled, was, in the attorney's words, when I finally told her what I suspected months later, exactly the kind of thing this provision was supposed to prevent. That confirmed something important. This wasn't a case of an ambiguous trust document being misread. This was a man deliberately unwinding the one safeguard his own mother had specifically built to protect her grandchildren from exactly this. Before any lawyer got involved, I tried one more time to resolve this the way families are supposed to, quietly, at a table, without lawyers or courts. In January, I asked my mother to help arrange what I framed as a conversation, and my father agreed. I think because he had believed it was still salvageable through charm alone, the same way he'd talked his way out of 100 smaller disputes over the years. We met at a neutral location, a conference room at his own accounting firm, which in hindsight tells you everything about the power dynamic he was trying to preserve, even in a conversation meant to address wrongdoing he'd committed against me. I brought a simple, calm proposal, full voluntary disclosure of every transaction connected to the trust since 2009, an independent audit paid for jointly, and a repayment plan for whatever the audit found. I wasn't asking for punishment. I was asking for honesty and restitution, the two things a functioning family relationship requires after harm has been done. He listened to the whole thing without interrupting, which I mistook for one hopeful minute as a good sign. Then he said, "I'm not going to let you put me through an audit like I'm some kind of criminal. I raised you. I've given this family everything. If you want to blow all of that up over some paperwork misunderstanding, that's on you, not me." I asked him directly whether he would at least agree to have an independent, licensed fiduciary review the trust's full history. No lawyers yet, no filings, just transparency. He refused, again citing principle, and then said something that, more than any bank statement, is what finally convinced me there was no version of this that ended with an honest conversation. "You've spent your whole life needing to be the victim of something. Don't make this that thing." That sentence is why Act 2 of this story doesn't end in a family kitchen. It ends in a lawyer's office. A person with nothing to hide does not respond to a request for transparency by accusing the person asking of manufacturing victimhood. That response is, itself, a form of evidence, not the kind you can answer into a courtroom, but the kind that tells you with total clarity which road you're actually standing on. I left that meeting and called Patricia Nguyen's office the following Monday. That's where Act 2 ends, with the manila envelope in a basement and the number that would eventually total $312,000. In the next act, I'm going to walk you through exactly how I turned 7 photographed statements into a full forensic case, how I found the second family my father had been hiding in Florida, and how close he came to shredding the evidence before I ever got to see it. Before I get into the forensic work, I want to talk for a moment about how I chose Patricia, because I think the process itself is useful for anyone facing something similar. I did not hire the first attorney I found. I consulted with 3 different trust and estate litigators over the course of about 2 weeks, using free initial consultations that most firms in this practice area offer. The first attorney I spoke with focused almost entirely on how expensive and emotionally draining litigation against a parent would be, which, while not wrong, felt more like a warning than a strategy. The second seemed knowledgeable, but represented mostly high net worth estate planning clients and admitted candidly that active fraud litigation wasn't really her focus. Patricia was different from the first phone call. She asked specific, pointed questions. When did the trust's custodian change? Did I have any original account statements predating that change? Had I made any written requests yet? The kind of questions that told me she was already building a mental case file rather than just gauging whether I'd be a paying client. She also gave me something the others didn't, a clear-eyed, honest assessment of both the strength and the limits of what I had at that early stage. A basement envelope and a gut feeling isn't a lawsuit yet, she told me in that first call, but it's more than most people ever bring me. Get me a forensic accountant and let's see what we're actually dealing with. That combination of honesty and momentum is, I'd argue, exactly what you want from anyone you're trusting with the case this personal. I want to be honest with you about something. I am not a lawyer, an accountant, or a private investigator. I run a nonprofit, but I had spent 8 years teaching low-income families how to read financial documents, spot fraud, and build paper trails to protect themselves from predatory lenders. And it turns out those same skills work just as well when the predator is your own father. The first thing I did was pull the Ohio Secretary of State's business registry. Whitfield's Capital Advisory, LLC, had been formed in March 2009 with a registered agent address matching my father's accounting firm and a single listed member, Gordon R. Bennett. There was no ambiguity there. This wasn't some obscure vendor of the trusts. It was a company my father had personally created 6 years after becoming trustee, using his mother's maiden name as camouflage. I reached out to a college friend, Dave Ostrovsky, who had spent 12 years as a forensic accountant specializing in trust and estate litigation. I told him what I had. He didn't sugarcoat it. "Rachel," he said, "if what you're describing is accurate, this isn't a gray area. This is a textbook breach of fiduciary duty. And depending on how the money moved, it could be criminal embezzlement and potentially mail or wire fraud if statements or transfers crossed state lines." Dave agreed to review everything I had, off the books at first, as a favor. Using the 7 statements from the basement and the LLC's public registration, he helped me file a request with our county recorder's office and pull additional public records, UCC filings, property records, court dockets, anything with Gordon Bennett or Whitfield's Capital Advisory's name attached. What we found next changed the entire shape of the story. In 2015, Whitfield Capital Advisory LLC had purchased a condominium in Destin, Florida, for $209,000, paid largely in cash. The deed listed 2 names as co-owners, Gordon R. Bennett and a woman named Denise Halloran. I had never heard the name Denise Halloran in my life. A little more digging, property tax records are public, social media is public, and Denise Halloran, it turned out, was not a careful woman when it came to what she posted, revealed that she had been in a relationship with my father since at least 2011. There were photos going back years, anniversary posts, a photo from 2019 captioned 8 years and still my favorite trip, geotagged at that same Destin condo. My father had been living a second life, 4 states away, funded almost entirely, based on the transfer dates we now had, by regular wire transfers from Whitfield Capital Advisory LLC, the same LLC that had been draining my trust since 2009. I remember calling my husband from my car in a grocery store parking lot, unable to go inside because I had just realized that every market downturn my father had ever explained to me over the phone had a name, and her name was Denise. Here's where the investigation took a turn I genuinely wasn't prepared for. Dave and I kept pulling threads on Whitfield Capital Advisory's outgoing transactions, and we found a second, separate pattern. 5 transfers between 2017 and 2019 totaling $91,000 paid directly to Bennett Motors, my brother Kyle's dealership. I confronted Kyle about it, carefully, without revealing everything I knew. At first, he denied any knowledge, but when I told him I had the wire records, he admitted that in 2017, his dealership had nearly gone under after a bad inventory financing deal, and that our father had helped him out with what Kyle believed at the time was a personal loan from Dad's own retirement savings. Kyle insisted he had no idea the money came from my trust. I believe him, mostly. But it meant that the golden child narrative I'd grown up under, the story that Kyle succeeded because he simply understood money better than I did, had a much simpler explanation. Kyle's success had been subsidized quietly by money stolen from me. That detail would matter enormously later, but at the time, it just made me sick. I want to walk you through the moment the case became airtight, because up to this point, everything Dave and I had was circumstantial. Damning, but circumstantial. A shell company, a hidden condo, transfers that looked bad. What we needed was direct proof connecting the trust account itself to Whitfield Capital Advisory, something that showed unambiguously that the money moving into that LLC came from my grandmother's trust and not from my father's own legitimate assets. That proof came from a source I hadn't expected, the original trust custodian. My grandmother's estate attorney, before she passed away in 2019, had used a regional trust company, Miami Valley Trust and Fiduciary Services, to hold the account before my father, as trustee, transferred custody to a different, less regulated broker-dealer in 2010. Under Ohio's trust code, a beneficiary has the right to request records from a former custodian even after a transfer, because that custodian was, for a period, legally responsible for safeguarding the asset. Dave helped me draft a formal records request, citing the statute directly. 6 weeks later, a box arrived containing the original account records from 2003 to 2010, the years before my father moved the money to a custodian of his own choosing, away from professional oversight. Buried in that box was a single-wire authorization form dated April 2009, transferring $19,500 out of the Eleanor Bennett Educational and Opportunity Trust account directly into Whitfield Capital Advisory LLC's newly opened operating accounts. It bore my father's signature as trustee, authorizing the transfer with a handwritten memo line that read, "Temporary bridge, repay Q3." That repayment never happened. Not that quarter, not ever. That was the smoking gun. Direct documentary proof in my father's own handwriting connecting my inheritance to the shell company that funded his second household. From that single wire authorization, Dave was able to trace the pattern backward and forward, ultimately reconstructing 61 separate transfers over 14 years, totaling $312,400. With that in hand, I hired Patricia NGN, a trust and estate litigation attorney in Columbus, Ohio, who specializes in fiduciary breach cases. Patricia explained the legal landscape clearly. Under Ohio law, a trustee owes beneficiaries a fiduciary duty that includes loyalty, prudent investments, and full transparency. What my father had done, self-dealing trust assets into a company he personally owned for his own benefit, is one of the clearest, most textbook breaches of fiduciary duty a court can rule on. It also, because he had actively concealed it through false statements and a shell entity, meant the statute of limitations, which normally would have barred claims on transfers that old, was told under Ohio's discovery rule for fraudulent concealment. In plain terms, because he hid it, the clock hadn't run out. I could pursue every dollar going back to 2009. Patricia filed a petition in probate court to remove my father as trustee, compel a full accounting, and seek a surcharge, a court order requiring a trustee to personally repay a trust for losses caused by breach of duty for the full $312,000, plus prejudgment interest, plus attorney's fees. At the same time, because the misconduct involved a shell entity, forged wire authorizations, and statements mailed across state lines to conceal the fraud, Patricia and Dave helped me prepare a referral to the Montgomery County Prosecutor's Office and the Ohio Attorney General's Consumer Protection and Anti-Fraud Unit, and, given the interstate mail component, a complaint to the FBI's field office in Cincinnati for potential mail and wire fraud. Here's the moment that nearly ended everything before it started. 2 days after Patricia's office sent my father formal notice of the probate petition, required by law before any hearing, my mother called me in a panic. My father, she said, had spent the entire previous night in his home office with the shredder running. She'd found the trash can outside overflowing with shredded paper the next morning and had, without telling him, taken photos of the bags before the garbage truck came out of some instinct she couldn't fully explain. If he had managed to destroy the original custodial records, the ones we'd already secured copies of, thankfully, but which he didn't know that, the case would have relied almost entirely on documents I'd photographed myself, which any competent defense attorney could challenge as selectively obtained. Patricia moved immediately for an emergency preservation order, formally called a litigation hold, which legally requires a party to preserve all relevant records once litigation is reasonably anticipated, and which, if violated, can result in serious sanctions, including adverse inference instructions, where a judge tells a jury they're allowed to assume destroyed evidence would have been damaging to the person who destroyed it. The order was granted within 48 hours. My father, it turned out, had been shredding old tax preparation client files that genuinely had nothing to do with the case, a detail his own attorney would later confirm. But the panic it caused, and the fact that it happened literally within hours of receiving legal notice, told me everything I needed to know about what kind of man I was dealing with. Once the preservation order was in place, Patricia used a formal discovery tool, a subpoena ducis tecum, to compel both the trust's current custodian and Whitfield Capital Advisory LLC's bank to produce full transaction histories going back to account opening. This is a critical distinction worth understanding. A beneficiary can request an accounting from a trustee directly, but a subpoena, issued through active litigation, compels a third-party financial institution to produce records the trustee cannot filter, edit, or compile on his own timeline. It removes the fox from any role in guarding the henhouse. The records arrived in early spring, 1,100 pages, dense with dates, amounts, and routing numbers. Dave spent nearly 6 weeks with them, building what forensic accountants call a flow of funds analysis, a document that traces every dollar from its source account through every intermediate transfer to its final destination, establishing an unbroken chain of custody for the money. It is meticulous, unglamorous work, cross-referencing dates, reconciling rounding discrepancies, flagging any transfer that didn't have a clear matching entry on both ends. But it's exactly the kind of work that turns "we believe this happened" into "here is a document proving this happened," which is the entire difference between a lawsuit you might win and a lawsuit you will win. By the time Dave finished, he had reconstructed 61 distinct transfers from the trust's brokerage account into Whitfield Capital Advisory LLC between March 2009 and September 2022, ranging from $8,000 to $19,000 each, deliberately sized to stay below reporting thresholds. He'd also traced $91,000 of outgoing LLC transfers to Bennett Motors, $209,000 toward the Destin condominium purchase and its ongoing carrying costs, and roughly $12,000 in what could only be described as personal spending, restaurant charges, a jewelry purchase, two first-class flight upgrades, laundered through an account labeled on paper as a professional consulting business. I want to spend a moment on something that surprised me during this process because I think it's genuinely useful for anyone else trying to piece together a hidden pattern of behavior. How much of this case was built, in part, from things people posted publicly about their own lives without ever imagining those posts would end up printed and tabbed as exhibits in a probate filing. Denise Halloran's Instagram account, which was not private, gave us a timeline nobody could have reconstructed from bank records alone. Anniversary posts, a birthday dinner tagged at a restaurant 3 miles from my father's office on a night he'd told my mother he was at a conference in Columbus, a photo from the Destin Tondo's balcony with a caption thanking G for always showing up for us. None of that on its own proves financial fraud, but paired with the wire transfer dates Dave had already reconstructed, it corroborated the pattern precisely. The timing of consulting fee withdrawals from Whitfield Capital Advisory lined up again and again with trips, gifts, and anniversaries documented in a stranger's public photo grid. Patricia was careful to remind me, more than once, that anything gathered this way needed to be handled correctly, screenshotted with visible timestamps, saved through a proper archiving tool rather than a simple photo of a phone screen, and disclosed through formal channels rather than referenced casually, so that it would hold up if a defense attorney ever challenged its authenticity. It's a small detail, but an important one. Even true evidence can become useless in a legal proceeding if it isn't gathered and preserved the right way. There was one more moment during this stretch that I think about often. About a month into discovery, my father's attorney requested what's called a protective order, attempting to seal the discovery materials from public access, arguing that the case involved sensitive family financial matters that shouldn't be exposed. Patricia opposed it, pointing out correctly that Ohio probate proceedings are, with narrow exceptions, public record, and that a trustee accused of self-dealing does not get to hide behind family privacy to shield what is functionally a financial crime. The judge denied the motion. It was a small procedural ruling, the kind of thing that wouldn't make headlines on its own, but it mattered enormously because it meant that whatever happened in that courtroom, the consent judgment, the accounting, all of it would eventually become a matter of public record, verifiable by anyone, including any journalist who ever wanted to check. My father's attorney, I later learned, had specifically warned him that a denied protective order significantly raised the stakes of going to trial rather than settling. I don't think it's a coincidence that serious settlement conversations began less than 2 weeks later. I want to describe one meeting specifically because it was one of the strangest afternoons of my life. In late winter, following our formal complaint, I was contacted by a special agent from the FBI's Cincinnati field office who handles white-collar and financial crimes in our region. Asked to meet in person, along with Patricia, at a nondescript building downtown that did not, in any way, resemble the dramatic FBI offices you see in movies. Fluorescent lights, a conference room with a scuffed table, a box of tissues nobody needed yet. He was polite, methodical, and almost aggressively unemotional, which I found strangely comforting. He walked me through, slowly, the specific elements that matter for a mail and wire fraud referral under federal law, whether false statements were transmitted through the U.S. mail or interstate wire communications in furtherance of a scheme to defraud, and whether that scheme deprived a victim of money or property through material misrepresentation. He asked me to walk him through the timeline of every mailed statement I'd received, whether any of the false Meridian Growth Partners documentation had been sent to me by mail rather than handed to me in person, and whether any wire transfers had crossed state lines, which, given the Florida property and its associated banking, they clearly had. He was careful, more than once, to tell me that federal investigations move slowly, that his office receives far more referrals than it can immediately act on, and that the existence of a strong civil case does not guarantee criminal charges will follow. Prosecutorial discretion, resource constraints, and the relative strength of intent evidence all factor into whether a case like this ever reaches an indictment. He told me, plainly, not to build my sense of resolution around a criminal outcome I couldn't control. I appreciated that honesty more than I expected to. It's easy, watching stories like this one, to assume every case ends with handcuffs and a perp walk. Most don't. Most end exactly the way mine did on the civil side, with a documented court-enforced financial reckoning, while the criminal question continues, quietly, in the background, sometimes for years. While the civil case built toward a resolution, the criminal referrals were moving on their own slower and more opaque timeline, which is normal. Prosecutors and federal agencies don't operate on a family schedule, and Patricia was clear with me from the start that I should not expect the criminal side to resolve quickly, or necessarily at all. Many fiduciary fraud cases end up handled entirely through civil remedies, with criminal charges either declined or negotiated down, especially when restitution is made. An investigator from the Ohio Attorney General's Consumer Protection and Anti-Fraud Unit did interview me twice and asked for copies of everything Dave and I had compiled, which we provided. As of this recording, that investigation remains open, and out of respect for its integrity, I'm not able to share further detail. But I want to be honest with you that justice in these cases often looks less like handcuffs on a courthouse stair and more like a quiet, thorough process that takes months or years to fully play out, running in the background long after the headline moment everyone remembers. By the time Act 3 ends, I had a forensic accountant, a trust litigation attorney, a shell company traced to a hidden second family, 61 documented fraudulent transfers, a preservation order protecting the evidence, a denied protective order guaranteeing the case would eventually be public, and referrals sitting on desks at the county prosecutor's office, the state attorney general's office, and the FBI. And I had a TEDx invitation sitting in my inbox that I hadn't answered yet. Here's something I haven't mentioned yet, because I needed you to understand the full weight of it first. 2 months before I found that manila envelope in my parents' basement, TEDx Dayton had invited me to give a talk. The theme that year was Rewrite the Narrative, and they wanted me to speak about my work in financial literacy, about helping families who'd been failed by predatory systems build something stable from nothing. I said yes before any of this started. It was, at the time, simply the biggest professional honor of my career. By the time the case was fully underway, I had a decision to make. My original plan for the talk had been about financial literacy programs in underserved communities. Good, solid, unrelated to my own family. But sitting with Patricia one afternoon, going over the accounting one more time, I told her something I hadn't said out loud yet. I wanted to invite my father to the talk. She looked at me for a long moment and asked why. Because he's spent 30 years deciding what story gets told about me, I said. I want him in the room for the one time I get to tell it myself. I called him that weekend. I told him I had a TEDx talk coming up, that it would mean a lot to have him there, and that I hoped, despite everything going on with the trust dispute, we could set that aside for one evening. He said yes almost immediately. I think, looking back, he believed it was an olive branch. I think he believed I was finally, after 30 years, giving him the moment he'd always wanted, proof, in public, that his disappointing daughter had turned out fine after all, with him in the audience to take some of the credit. He had no idea that by the time I stepped on that stage, the civil case would already be resolved. Here's something important about how these cases actually work, and I want to walk you through it honestly rather than for pure drama, because the reality is more satisfying than fiction. 2 weeks before the TEDx event, facing a preservation order, a mountain of documentary evidence, and the very real prospect of a criminal referral moving forward alongside the civil case, my father's attorney reached out to Patricia to discuss settlement. This is common in fiduciary breach cases. A civil trial is expensive, public, and once evidence like a handwritten temporary bridge memo surfaces, very difficult to win. My father agreed to a consent judgment, full repayment of the $312,400 in embezzled principal, plus pre-judgment interest calculated at Ohio statutory rate back to each transfer date, plus my attorney's fees and Dave's forensic accounting costs. All told, the judgment totaled $461,000. He also agreed as part of the settlement to resign as trustee immediately and to fund the remaining trust balance from a home equity line against the house I grew up in. He did not, however, get to make the criminal referrals disappear. Civil settlements resolve civil liability. They do not and cannot make a prosecutor's office or the FBI drop an active investigation into embezzlement and potential mail fraud. That part was out of his hands and out of mine. 3 days before the TEDx event, Patricia called to tell me the settlement had been finalized and the funds had been wired into the trust's restored account. I sat with that for a long time, and then I finished writing my talk. In the week between the settlement finalizing and the event itself, I wrote 2 versions of my talk. The first was the original, safe, professional, entirely about financial literacy work with no mention of my father at all. The second was the one I eventually gave. I want to be honest that I went back and forth between them almost until the night before. And I think it's worth walking through why, because I don't want this to sound like a decision I made lightly or vindictively. I called Patricia the Tuesday before the event and asked her directly whether there was any legal risk in speaking publicly about a case that had just settled. She explained that because the consent judgment was now entered as a public probate court record, and because I would be speaking only to documented, verifiable facts already part of that record, not to anything private, unproven, or defamatory, I was on solid legal ground. She did caution me about one thing specifically, to stick strictly to what could be substantiated by the court filings and the forensic accounting, and to leave out anything, like Denise's full identity, that wasn't essential to the facts of the fraud itself. That advice I followed carefully, both on stage and in this video. I also talked it through with my therapist, who asked me a question that ended up shaping the entire final version of the talk. What do you actually want this moment to accomplish? I sat with that for a long time. I realized I didn't want revenge exactly. The money was already recovered, the legal case was already resolved, nothing about the talk itself would change the financial outcome. What I wanted was something quieter and, I think, more important. I wanted, for one evening, for the true story to exist in the same room as him, spoken in my own voice instead of filtered through 30 years of his narration. I wanted the record corrected, publicly, not for the internet, not for revenge content, but for the 14-year-old girl who got a B+ in geometry and believed for the rest of her life that this made her a disappointment. Once I understood that, writing the final version took less than a day. The night of the event, I watched from backstage as my father found his seat in the 3rd row, next to my mother wearing the navy blazer he always wore to things he considered important. He waved when he saw me glance out from the wings. I waved back. My original talk description, the one printed in the program, still read, "Building Financial Resilience in Underserved Communities." I hadn't changed it. I wanted him settled in his seat, comfortable, expecting exactly the talk he thought he was going to see. His daughter, the nonprofit worker, finally proving her worth in front of an audience, with him there to receive the reflected credit for raising her. I walked out to applause. I started exactly where the program said I would, talking about the families I'd worked with, a woman named Tanya who'd rebuilt her credit after a predatory car loan, a man named Marcus who'd bought his first home at 49 after years of being told he'd never qualify. The audience was warm. My father was smiling. I could see him from the stage, nodding along exactly the way he used to nod at Kyle's football games. And then, about 11 minutes in, I said this. I built my entire career teaching people how to protect their money from people who want to take it. And for most of my life, I thought the biggest financial danger most families face is a stranger, a scam call, a predatory lender, or a fraudulent contractor. I was wrong. The most dangerous person in most people's financial life is someone they already trust completely. Someone with a title, a CPA license, a key to the account. Someone who spent years making sure you never feel qualified to ask a single question. I put the first slide up. It was the manila envelope from the basement, photographed exactly as I'd found it. In November of last year, I said, I found out that a man I trusted completely had been stealing from me for 14 years, $312,400, taken from a trust my grandmother left me, funneled through a shell company built using her own maiden name, so that if I ever noticed anything, it would look like it belonged to her. I watched my father's face change in the third row. I watched my mother's hand go to her mouth. I put up this second slide, the wire authorization form, his handwriting clearly visible, temporary bridge, repay Q3. I put up the deed to the condo in Destin. I did not use Denise's name. That detail, I decided, belonged to a different conversation, a private one, not a stage. But I said clearly that the money had funded a second household he kept hidden for over a decade and had propped up a family business while I was told my entire life that I simply didn't understand money as well as the people it was actually funding me. 3 days ago, I said, my voice steady in a way that surprised even me, a consent judgment was finalized. $461,000 repaid in full, plus interest, plus everything it cost me to prove it. The trustee resigned. The investigation into potential criminal charges is ongoing with the Montgomery County Prosecutor's Office, the Ohio Attorney General, and the FBI's Cincinnati Field Office. I looked directly at the third row. For 30 years, my father called me the family disappointment. Tonight, I wanted him here, in this room, when I told the true story instead of the one he's been telling about me my whole life. The room was completely silent for what felt like an eternity, and then it wasn't. 800 people rose to their feet. My father did not. He and my mother left before the closing remarks. He did not speak to me that night or for several weeks afterward, but the video of the talk, TEDx events are recorded and typically published to YouTube and TED's platform, once cleared for release, was posted 6 weeks later, and it did something I never anticipated. It went far beyond the room. Local news in Dayton picked it up. A consumer investigative reporter at the Dayton Daily News ran a follow-up piece verifying the public court filings from the probate case and confirming the consent judgment amount through court records, which are a matter of public record once entered. That kind of public attention has real consequences for someone whose entire professional identity is built on trust. The Ohio Accountancy Board opened its own review after the news coverage, examining whether my father's conduct as a fiduciary violated the professional and ethical standards required to hold a CPA license. 2 of his longtime accounting clients terminated their relationship with Bennett and Associates within the month, citing the coverage directly in their termination letters, which Patricia obtained during a related discovery process. His name, once a fixture of local respectability, Rotary Club, church treasurer, the mayor's handshake photo, became, for a period of weeks, the subject of the exact kind of scrutiny he'd spent his career helping other people avoid. I am not going to pretend I felt nothing but satisfaction watching that unfold. I felt grief, too, for the father I'd wanted for 30 years, who never existed the way I imagined him. But I want to be honest with you about something, because I think it matters more than the drama. The moment that actually mattered to me wasn't the news coverage or the board review. It was $312,000 sitting back in an account with my name on it, restored with interest because I refused to accept being called a disappointment by the person who'd been quietly disappointing me the entire time. I mentioned the news coverage briefly, but I want to slow down on what that actually looked like on the ground, in a town where my father had spent 35 years building a reputation as the trustworthy guy, because I think it matters for understanding what public shame really means outside of a headline. Within a week of the Dayton Daily News follow-up piece, the Bennett and Associates Facebook page, a page my father had used for years to post friendly reminders about tax deadlines and photos from the firm's annual client appreciation picnic, was flooded with comments. Some were cruel in ways I didn't feel great about, even then. Most were simply people processing the dissonance of learning that someone they trusted with their own family's finances had been doing this quietly for over a decade. A woman I didn't know commented that she'd had my father prepare her elderly mother's taxes for 9 years and was now requesting a full independent review of every filing he'd ever touched for her family, just to be sure. I don't know what that review found. I never asked. But I understood, reading that comment, that the damage from a story like this doesn't stay contained to the family it started in. My father closed the firm's public social media accounts within the month. He did not attend Rotary Club for the rest of that year, a fact I learned not from him but from my aunt, who mentioned it almost as an aside during a phone call, the way you'd mention weather. The mayor's office, whose photo with him had hung in his private office for over a decade, quietly took down a joint photo from a local business association's website after a reporter asked about it directly. I am not going to tell you I felt uncomplicated joy watching a town slowly recalibrate its opinion of my father. Some of it, honestly, made me sad in ways I didn't expect. Not for him, but for the version of my childhood where I'd believed, at least a little, that his public reputation reflected something real. What I will tell you is that it also confirmed something I needed confirmed. The story I told on that stage wasn't an exaggeration, wasn't airing family business for sympathy, and wasn't, as he'd once accused me during that failed mediation, me needing to be the victim of something. It was simply, finally, the truth, arriving in a form specific and documented enough that an entire town could look at it and reach their own conclusion without needing to take my word for anything. I mentioned the Ohio Accountancy Board review briefly, and I want to give it a little more room, because for a man whose entire identity was built on a CPA license, this was, in practical terms, the single most consequential piece of fallout from that stage. Professional licensing boards typically operate independently of both civil courts and criminal prosecutors, with their own investigative process and their own standard of proof, usually a lower bar than beyond a reasonable doubt, closer to a preponderance of the evidence, similar to a civil case. Once the board opened its file, it requested copies of the consent judgment, the forensic accounting Dave had prepared, and the underlying court record from the probate case, all of which were by then public. Under Ohio's accountancy statutes, a CPA found to have engaged in a breach of fiduciary duty involving client or family funds can face licensure sanctions ranging from a formal reprimand up to full revocation, along with mandatory disclosure requirements that would follow him to any future professional application. As of this recording, that review is still active, and I'm intentionally not going to speculate on its outcome. But I want you to understand what's actually at stake in it. Not just whether my father can keep practicing under his own name, but whether every future client who might have trusted him with their own family's money the way I once did will ever get the chance to. I promised you at the start of this video that you'd understand exactly where the money went, and I want to close this act by putting it all together plainly, because it's the detail that reframes everything. $91,000 of my inheritance kept my brother's failing car dealership alive in 2017, allowing him to present himself for years afterward as the son who simply understood money, proof in my father's eyes that he'd raised one child right. $209,000 bought a condo in Destin, Florida, co-owned with a woman my mother never knew existed, funding a second relationship my father maintained for over a decade while sitting across from me at Thanksgiving telling me I didn't understand sacrifice. The remaining balance covered consulting fees that were, in reality, nothing more than a line item my father invented to move cash out of the LLC without raising suspicion from his own firm's compliance software. Every dollar of my disappointment funded someone else's version of success. That's not a metaphor. That's the actual, forensically documented, court-verified accounting of where my inheritance went. I want to close this act with my brother because his part of the story didn't end the way I expected. In the weeks after the talk went public, Kyle called me, not to defend our father, which is what I'd braced for, but to apologize. He told me he'd gone back through his own dealership's books after seeing the TEDx video and had found the same 2017 transfer Dave and I had already traced, this time from his side of the ledger, labeled in his own records simply as Dad, Loan. He said he'd never asked where the money came from because, in his words, I didn't want to know badly enough to ask. I don't think that excuses it, but I do think it's a different kind of failure than my father's, and over the following months, Kyle and I rebuilt something we hadn't really had since childhood, a relationship that didn't run through our father as the only judge of who deserved what. Kyle has since begun repaying voluntarily the portion of the $91,000 that came from my trust rather than our father's own funds in monthly installments we agreed on privately without lawyers because, for once in our family's history, it felt more important to trust each other than to protect ourselves from each other. I haven't said much about my mother in this story, and I want to correct that before we close, because her part in it is more complicated than a simple villain or bystander framing allows. I don't believe my mother knew about Whitfield Capital Advisory, the Destin condo, or Denise Holleran before I found them. I believe, based on everything since, that she was as blindsided as I was, perhaps more so because the second household wasn't just a financial betrayal for her, it was a marital one, layered on top of everything else. In the months after the settlement, she filed for divorce. She has told me more than once that watching me lay out the evidence, first at that kitchen table, later in the court filings she eventually read in full, was the moment 31 years of small, unexplainable inconsistencies in her own marriage finally resolved into a coherent, terrible picture. She has since become, unexpectedly, one of my closest allies in all of this, attending the probate hearings, helping me track down old family financial documents from a marriage she now understands very differently than she did a year and a half ago. I share this not to pile on, but because I think it's honest to the way fraud like this actually radiates outward. My father didn't just steal from me. He built an entire architecture of concealment that required deceiving my mother for over a decade about where their shared money and time were actually going. The disappointment he assigned to me for 30 years was, it turns out, a role he needed someone to play so that no one would look too closely at the role he'd assigned himself. It's been just over a year since the talk. The trust, restored with interest exactly as the consent judgment required, is invested conservatively through a licensed, independently custodied advisor Dave helped me vet personally, someone with no connection to my family whatsoever. I check the statements every quarter now, not because I don't trust the advisor, but because I promised myself, sitting on that bathroom floor searching for Meridian growth partners, that I would never again be a person who didn't ask. My relationship with my father remains, as of this recording, unresolved. We have spoken twice since the talk, both times brief, both times tense. He has never, in either conversation, said the word sorry. He has told me more than once that I destroyed the family to make myself look good. I no longer feel the need to argue with that version of events. I know what the wire authorization form said. I know what the consent judgment says. I know where the money went. For 30 years, he got to decide which story about me was true. I only needed one evening on one stage to make sure the actual facts were on the record, permanently, in a form no shredder could reach. I want to end this the way I try to end all of these stories, not just with the satisfaction of watching a predator finally face consequences, but with something you can actually use. Because if this story resonated with you even a little, I want you protected the same way I eventually was. Here are the warning signs, based on what I lived through, that a family member or trusted advisor may be financially exploiting you. First, information control. If someone manages money on your behalf and consistently resists giving you documentation, statements, account numbers, transaction histories, and frames your request as a personal insult or a sign of distrust, that is not normal fiduciary behavior. A legitimate trustee, advisor, or family manager should welcome transparency, not punish it. Second, unverifiable investments. If you're ever told your money is in a fund, entity, or vehicle you can't independently verify through the SEC's Edgar database, FINRA's broker check, or your state's securities division, that is worth investigating immediately. Meridian Growth Partners didn't exist anywhere but on a piece of paper my father printed himself. Third, convenient timing around loss. Be cautious of financial explanations that always trace back to broad, unverifiable market conditions, like the market was rough, we took a hit like everyone, especially when they arrive alongside years of resistance to sharing actual account data. Fourth, and this one is less about paperwork and more about pattern, pay attention to people who use your self-doubt as a management tool. If someone has spent years making you feel unqualified to ask questions about your own money, that is not a personality trait. In my experience, and in the experience of a lot of people who've written to me after stories like this one, it is very often a deliberate strategy. If you have the legal right to request a formal accounting, and in most states trust beneficiaries do, exercise it in writing by certified mail and keep a copy. If a professional stalls, delays, or gets defensive about a request that should be routine, that reaction is information in itself. I get asked constantly in the comments on videos like this one what someone should actually do if they suspect a family member or trusted advisor is mishandling their money. I'm not a lawyer, and nothing here is legal advice for your specific situation. But based on what I lived through and what Patricia and Dave taught me along the way, here is the order of operations I'd recommend. Start by requesting documentation in writing, not conversation. A phone call can be denied or reframed later. A certified letter with a return receipt creates a time-stamped record that the request was made and received, which matters enormously if you ever need to show a court that you acted diligently and were stonewalled. While you wait, quietly verify anything you're told independently. If you're given a fund name, an advisor's name, or a firm name, check it against FINRA's broker check, the SEC's Edgar and investment advisor public disclosure databases, and your state's securities division. These are free public tools, and a fund or advisor that doesn't appear in any of them is not automatically fraudulent, but it is automatically a reason to ask harder questions. Don't confront before you document. I know how counterintuitive this feels, especially in the heat of realizing something is wrong. But the moment you show your hand, any paper trail still in the other person's control becomes vulnerable. Gather what you can, quietly and legally, meaning records you already have a right to access, not anything obtained through hacking, deception, or violating someone else's privacy, before you ever raise the subject directly. Bring in professionals before you need them, not after. A forensic accountant and an attorney who specializes in fiduciary or trust litigation can often tell you in a single consultation whether what you're looking at is a real problem or an innocent misunderstanding. And if it is a real problem, they know which legal tools, like preservation orders and third-party subpoenas, actually work and how fast they need to move to stop evidence from disappearing. And finally, understand that civil recovery and criminal accountability are two separate tracks on two separate timelines, and you may get one without the other. That's not a failure of the system, it's simply how it's built. Getting your money back with interest through a civil judgment is very often the more realistic and more immediate form of justice available, and it is still justice, even without handcuffs. If you've been through something like this, whether it was a parent, a spouse, a business partner, or someone else who used your trust against you, I want to hear about it. Tell me what happened in the comments below. This community has helped more people than I can count simply by showing them they weren't the only one and that these things can be undone. One more thing, because I think it matters as much as any of the legal steps I just walked through. If you grew up being told by someone who was supposed to protect you that you were the disappointment, I want you to hear this clearly. The story someone tells about you, even for 30 years, even from someone whose approval you wanted more than almost anything, is not the same thing as the truth. Sometimes the truth just takes longer to get its own microphone. If this story meant something to you, subscribe, because we tell one of these every single week. Real financial predators, real paper trails, and real justice, dollar for dollar. I'll see you in the next one.